Good evening, Business 630 students. This is Professor Hassey. It's Tuesday, April 25th, and this is our introduction to capital, cost of capital, and capital budgeting, which we'll spend the next 2 weeks on, week number 4 and week number 5, here in our third, or the second half beginning of our Business 630 course. This is the halfway point of our class, and I'll talk a little bit more about that later. But by now, most of you have completed case number 1. Some of you are still on extension, and we'll post that within the next day. I will post the grades by Friday for case number 1. This week now you have case number 2, which will be a capital budgeting analysis and a risk analysis of a company. Some of you have taken finance before and probably know a little bit about capital budgeting. Others have not. So this week I'll be starting from scratch about what cost of capital and capital budgeting is in this first week of our study in this regard. The bottom line of all this is to prepare a spreadsheet, which I give you the template, and complete a case number 2 capital budgeting analysis. You have 2 weeks for this case work. It is not due until Sunday, May 7th. So for those in our class who are a little bit more experienced, they could knock that out maybe this week. There is no writing at all. It's just calculating on a spreadsheet that I provided the information and the answers for this analysis, of which we'll look at samples during the course of this week's study. So 2 weeks to do case number 2. This is an analysis of an investment in an asset, and is that investment in the asset providing an adequate return for the company? And we'll take a look at that in our lectures on Friday of this week and also into next week. We're going to be doing investment return analysis using 4 key figures or 4 key disciplines to determine that return on investment: net present value, internal rate of return, profitability index, and payback in years. We'll continue with this analysis in week number 5. So let's take a look at our Blackboard and see where everything is this week as we begin our study of capital budgeting. Okay, here's our Blackboard. I'm sure now that we're in the 4th week or the halfway point of our class, you're beginning to get used to it. Any questions or concerns, please feel free to let me know. Matter of fact, in our student discussion forum now is week 4, and in week 4 question and comments says, any questions concerning case number 2 and this week's topic, capital budgeting, please post to this discussion forum and Professor Hassey will respond. In addition, this week is our halfway week of our Business 630 course, a good time to address any issues you may have about the study or the delivery of our course. Please feel free to comment or ask questions of me. So if you have any concerns or any issues, you don't feel like you're getting your value out of this course, please feel free to comment. Remember, I'm a big boy. I can take any criticism or any positive comments. Please do, now that we're at the halfway point of our class. Also, remember, we have office hours on Tuesday and Thursdays. At the time of this video is being done, our office hours have been completed. But also remember, we have office hours on Thursday from 6 to 8 o'clock, student hours, if you'd like to Zoom and ask me any questions. Our case study has now been posted to the case study format. You can download these 3 files, really, 2 files, PDF and a Word doc explaining the case, and the rubric explaining how I'll be grading the case. And then finally, the actual spreadsheet template. It's an Excel spreadsheet that you will download and do all your work for this case on that spreadsheet. You do not have to create the spreadsheet. You will use this spreadsheet. If you're using Apple numbers, you can convert that Excel spreadsheet to Apple numbers, or probably a lot easier is just ask your Mac to look for that Excel spreadsheet and work in the Excel format on your Mac. Either way. But that's all the work will be done on that spreadsheet. So if you turn in something else, you will not get credit for this case. Everything has to be on the spreadsheet, and we'll talk about that a little bit later as well. So that's where our case number 2 format is. And here is week number 4 with our learning assignments for this week: an introduction to capital budgeting analysis, a definition and a very good PowerPoint on the definition of the cost of capital, and some PowerPoints and some additional videos that might help you in getting up to speed on this first week of our 2-week extravaganza of exploring capital budgeting. So what I would like you to do this week is, first of all, download this case and read it. See what looks familiar, what looks confusing, and then in your study of our videos and of the material, you fill in the blanks and start beginning to feel that you can do the work that I'm asking. This is a case called a capital budget risk analysis. It's to provide an investment analysis in a spreadsheet to determine an investment of $700,000 in an investment is going to prove worthy. In other words, give an adequate return. What's an adequate return? Anything above the cost of capital, which you also have to calculate in this analysis. So first of all, the cost of capital. What does the money, what's the discount rate? Well, I give you that the debt to assets relationship is 65%. The interest rate on the debt is 8.5% of this company. The risk-free rate is 3.5%. The market premium rate is 9%, and the firm's beta is 1.25. With all that information, you can determine the cost of capital. Once that cost of capital is completed, then you put together a spreadsheet for a 7-year investment of $700,000 in year 0, with a depreciation of $100,000 a year, a salvage value of $55,000, working capital base of 8%, an inflation rate for the selling price of 2% a year after year 1, an inflation rate for the variable cost of 1.5%, and for fixed cost 1.5% after year 1. The project tax rate is 20%. The units sold per year is 40,000. The selling price per unit is $45. Fixed costs are $75,000, and manufacturing costs per unit or variable costs are $35 per unit. With that information, you can project the cash flow and determine the cost, the return, using the net present value, internal rate of return, profitability index, and payback methods to determine that. Once that is done, the final tab on the spreadsheet template is to prepare a risk analysis using scenario and sensitivity as determining your risk. That's the case. What we're going to be discussing this week and next is how to do this and how to put it in a reasonable strategic mode to make a strategic decision on whether this investment in this asset is feasible. Every company does this analysis before they allocate the dollars to any capital budget process. Very important in finance. That's your case. So our job over the next week is to prepare you, or my job is to prepare you to do this spreadsheet case analysis. This is what we're doing this next couple of weeks. We're doing a capital budget analysis. Now, what a capital budget is, a company wants to invest in a new asset to grow the business, to provide cash flow, to provide profits, or a new market. So they're going to invest assets. In other words, invest capital. Where do they get the money to fund those assets? What is it going to cost them in debt, in equity, to get those assets? What is the depreciable life of those assets? That sets the length of time of the capital budget analysis, the depreciable life. What are the planned income, revenues, operating expenses? What's the net cash flow per year of that investment? That includes working capital, salvage value. And then once you compile the net cash flow per year, what is the net present value? What is the percentage return? What is the profitability index relative to cost? And how many years does it take you to pay back the initial year zero investment? And then once that's completed, what is the risk of the numbers? Are the numbers you're working with correct? Do they make sense? That's the scenario and sensitivity analysis. It seems like a lot, but once we get it all done and organized, no problem. Easy for me to say, huh? So this is the file that it will be our initial look at the capital budget analysis talked about in chapters 9, 10, and 11 over the next couple of weeks. Remember, the first step is to determine the cost of capital. What does it cost us to get the money to invest in an asset? We've looked at these components already. Now we're going to put them together into a calculated analysis. Here's the example we're using here. Our debt to assets percentage is 60%. In other words, 60% of the capital structure is in debt, interest-bearing debt. Interest-bearing debt at 9%. The company's tax rate is 30%. So if their debt position is 60%, that means their equity position has got to be 40% in their capital structure. It's got to total 100%. Their cost of that equity, or 40%, is determined by the capital asset pricing model. The risk-free interest rate relative to the market premium rate and the company's specific beta. So let's put together this cost of capital. If our interest rate on our debt is 9%, we're going to take that 9% and multiply it times 1 minus the tax rate of 30%. In other words, we're trying to determine the after-tax cost of debt. What is, we have to pay 9% on the debt. That's no questions asked. But also we get to deduct a certain portion of that debt based on our tax rate. So we get to deduct 30% of the 9% on as a tax deduction. So our true cost of debt is less the tax of 30%, or 9% times 70%, and that is, oops, excuse me, put the numbers in wrong. Let's do that again. 9% times 1 minus 30%, and we get, okay, Mr. Hasse, let's go back to the drawing board here, equals 0.09 times 1 minus 0.3 that. And there we go. All right, put in the wrong zeros. 6.3%. Sorry about that. I looked like an idiot. So 9% times 1 minus 30% is 6.3%. That's our after-tax cost of debt. That's what it's costing this company to pay for their debt after taxes. So we weight that by the capital structure of the debt, 60%, and we get a weighted average cost of debt of 3.78%. That's taking 60% of our 6.3. Okay. Now, what is our cost of equity? Well, you've done this before in your case number 1. The cost of equity is the capital asset pricing model, which is the risk-free rate, 0.0375, plus the market premium, which is in this case, it's given, you don't have to calculate it. Remember, the market premium is defined as the market rate of return minus the risk-free rate. Well, here I give you the market premium, so we're going to add that to 0.09, the market premium, times the beta of the company, 1.25. And we get 15%. So 3.75 plus 9% times 1.25 equals 15%. Pretty high cost of equity. So we put that cost of equity of 15% and we weight it by the 40% capital structure percentage of equity in the balance sheet, we get a weighted average cost of equity of 6%. Thus, we have our cost of capital. At this point of time, due to our cost of debt, our capital structure percentages, our tax rate, the risk in the market at no risk, risk-free rate, and average risk, market premium, and the specific risk of the company in the market, the beta, we have a cost of money of 9.78%. That's what it's costing us to get our capital today. So that 9.78% is going to be our discount rate once we put together our capital budget analysis. And so let's put this right here, 9.78. That is our percentage of WACC for our analysis. So now what we're going to do, we're going to make an investment of $1 million. We're going to have a salvage value. We're going to have depreciation. We're going to have units sold. We're going to have sales price. We're going to have inflation. We're going to have variable cost per unit. We're going to have inflation. We're going to have fixed cost per unit. We're going to have inflation. We're going to have a tax rate, and we're going to have a working capital rate. Our job this week is to fill this in. I'd like you to try to do that during the course of the week. And then on Friday, I will walk through this and see if your work is the same as mine. We'll determine the net present value, internal rate of return, profitability index, and payback, all talked about in chapters 9 and 10. We'll do the risk analysis, talked about in chapter 11. That's going to be jumping ahead of next week, but we'll be doing that as well. You're doing all of this analysis, this exact same sheet, except the numbers are different and the years are different for your case number 2. To be able to strategize and interpret an investment, you have to understand the decision-making into that investment, and that's what this capital budget analysis is. So if you want to try to give this a whirl during the course of the week, go right ahead. If not, I will walk us through in our Friday update video. Friday update video is going to be quite involved. We're going to go over this. We're going to go over the template for the case number 2, and we're going to go over the results of case number 1 so you understand how I graded that work and what was the outcome of that assessment. So a lot going on in the Friday update video. This week, we're setting it up. Your job is to maybe look at this spreadsheet, look at the material, and see if you can put this together. If you notice in the spreadsheet, I have a lot of the formulas or math or the arithmetic already done, which makes it a little easier. So go ahead and try to do this. If not, just go ahead and study this work in chapters 9 and 10, review it, get back up to speed on a capital budget analysis, and we'll go from there. But before we go, let's take a quick video to explain this process again. So let's take a look at that video.
The goal of capital budgeting analysis is to determine whether a project is profitable based on today's dollar value. This approach is appropriate because the project costs are in today's dollar value and the expected cash flows from the projects are in future dollar value. To make a decision on whether to accept or reject a project today, both cost and future cash flows must be in today's dollar value. The factors involved in capital budgeting decisions are future sales, expected cash flows, capital expenditure, timing. The purpose of any investment is to generate profit. To generate profit, first the firm needs to generate sales, manage costs, produce positive cash flows that are large enough to recover the investment, and generate profit. In addition, business does not have access to unlimited capital, and the availability of capital will influence the investment decision. The timing of each cash flow affects the present value of cash flow, and the timing of investment will affect the future revenues. Capital budgeting projects are generally classified as replacement, expansion, safety, security and environment, and other. Companies have to replace old equipment equipment because of breakdowns, lower productivity, or technological obsolescence to maintain the production capability of the firm. Replacement projects are the most common capital budgeting project in the business. Expansion project occurs as a result of company's strategy to produce new product or to enter new market or new industries. A change in environment and government regulation leads to safety, security, and environmental projects. Other projects are research and development project based on the strategic planning of the firm. The goal of the capital budgeting analysis is to determine the profitability of the project. Profitability of the project is determined by analyzing three cash flows of the project. 1. Cash outflows, the money invested in the project. 2. Cash inflows, money generated from the investment. 3. Terminal year cash flows, money received from the sale of the used assets at the end of the project. Let's draw a timeline for capital budgeting project. Assuming the life of the project is 5 years. Cash outflows are posted on the left-hand side at period 0. The cash flows are negative because money is going out of the company. Cash flows generated from the project are referred to as cash inflows and occurs after the investment. They are positive because money is coming into the firm. Assuming that the equipment can be salvaged, the salvage value and any other end-of-the-year cash flows from the project are posted on the year 5. The goal of the capital budgeting analysis is to determine profitability of the project. The investment in the project is made on period 0 and the cash flows will be received at a future date. In capital budgeting analysis, all the future cash flows, which is CF1, CF2, CF3, CF4, CF5, and terminal year cash flows for year 5 are brought to today's value by computing the present value of the cash flow. The difference between the present value of the cash flows and the initial investment is referred to as net present value. If the present value of future cash flows from the project is greater than initial investment, the net present value is positive and project is profitable. The following are commonly used decision criteria to evaluate capital budgeting project. Number 1, payback period. Number 2, net present value. Number 3, internal rate of return. Number 4, modified internal rate of return. Number 5, profitability index. Payback period. Payback period is the amount of the time required to recover initial investment in a project. It ignores the time value of money. Net present value. Net present value is the difference between present value of cash inflows and present value of cash outflows. Internal rate of return. Internal rate of return is the rate of return at which the net present value of the project is equal to 0. In the IRR calculation, it is assumed that cash flows from the project are reinvested at the internal rate of return. Modified internal rate of return. Modified internal rate of return is based on the assumption that cash flows from the projects are reinvested at the cost of capital, which is weighted average cost of capital. Initial investment is equated to the sum of the future cash flows that were reinvested at the cost of capital to compute the interest rate. Profitability index. Profitability index is the ratio between present value of cash inflows and present value of cash outflows. Project acceptance or rejection criteria. If net present value is greater than or equal to 0, project is acceptable. If the net present value is less than 0, reject the project. Internal rate of return is greater than or equal to cost of capital, project is acceptable. If the IRR is less than cost of capital, reject the project. Modified internal rate of return greater than or equal to cost of capital, accept the project. If MIRR is greater than or equal to cost of capital, project is acceptable. If MIRR is less than cost of capital, reject the project. If profitability index is greater than the 1, accept the project. Profitability index is less than 1, reject the project.
Okay, not the most thrilling of videos, I can honestly say, but it just gives us the overall view of what you see in front of you is a capital budget analysis. It's a determination of net cash flows, determining revenues and expenses, the initial year investment, your cost of capital, that's your discount rate, and the net year or life of the project by its depreciable life. So what we'll be doing is filling this in, determining our net cash flows, determining our investment return analysis by 4 different methods. Do not worry about the modified internal rate of return mentioned in that video. We will not be responsible for that. But what is our return in dollars, percent, disc in a ratio, and in years? That's what we'll be determining. Then coming out of that, we'll look at sensitivity analysis heading into the second week of our analysis. So that's what we're headed to this week. Try to review, try to set this up, and take a look at case number 2 and get a feel for what you have to do for that. And we'll talk more about that at the end of the week. So again, if you go to your Blackboard to week number 4, Here is my lecture spreadsheet that I was just talking about in the video, this week number 4 in-class spreadsheet. It's a blank one. Your job is to see if you can fill it in. If not, don't worry about it. I will post the solutions on Thursday of this week, and then I'll review those solutions in a separate file with the solutions on my Friday video. So you could get a head start at looking at that in Thursday. I'll post those early Thursday morning. So again, that's the spreadsheet. That's your template to understand what we're doing in case number 2. And then the template is actually provided you that you have to reconstruct. But basically, you just have to set up the arithmetic, and the file, the format is already there prepared for you. So we'll talk more about that in our Friday video, but that's your job this week, is to review that case, see what you know and don't know, and then prepare yourself to follow that spreadsheet analysis that I provided here in Blackboard. And again, here is that spreadsheet in that lecture for our lecture video tonight. I know you all can do the WACC calculation. You've already done the capital asset pricing calculation in case 1, and you could just do the simple arithmetic as described in my lecture video. You could prepare this, and if you want to, give a stab at it, establishing the cash flow analysis. But again, I will post this on Thursday. You can get a head start at looking at it, and then I'll review it on Friday video. That'll give you the good basis to begin your case 2 work. Or if you already think you can do it, go ahead and do it. And then our video on Friday, we'll take a look at the risk analysis, the scenario and sensitivity analysis piece of this case number 1, and then of this lecture, of this sample here this week. So that's what we're doing. The bottom line of all this is, in case number 1, we looked at and interpreted the risk and the credit livelihood and the risk analysis of a company, both qualitative and quantitative. That was your job in a paper format. Now, in case number 2, we're looking at, all right, can we crunch the numbers to review an investment? In the case of the example in front of you, we're making an investment of $1 million over its depreciable life of 10 years. Is this a worthy investment based on the cost of capital and the cash flow that's being generated off this investment over a period of time? Remember, the definition of project net cash flow is revenues minus expenses minus taxes, and then adding back in depreciation, working capital, and salvage value, if there is any in the case. In this case, in this example, the salvage is $50,000, but you need to do that after taxes. We'll talk more about that on Friday. So, okay, so we're off and running this week. I have my office hours on Thursday, student hours, if you need to ask some specific questions about that. I will post the grades for case number 1 no later than Friday, and you'll see those. Try to get them posted on Thursday. So if any of you want to review it in the student hours Thursday night, that might be ready. Again, this is the halfway point of our class. We've now looked at risk analysis. Now we're looking at capital budget analysis. And then in the final third of our class, we're taking a look at financial statement analysis with another case study. So we're off and running. Have a great week, everybody. Appreciated all your hard work on case number 1. And now we begin case number 2. Have a great weekend, everybody, and we'll see you all on Friday.